Hi, everybody. I'm trying to record what we should cover for this class because I know that everybody attended almost everyone uh, attended the career breakthrough, and I think it should be a very helpful, right, for you looking for a job and or at least get start to understanding what is network and what is alumni who are successful, what do they think they how did they success and what they wish they did when they are younger, right? So without the, I think that's very good time to spend. And then, however, we still need to catch up on chapter 3 for the first class. And from the session that before you guys, I know that a lot of people start having hard time to understanding what's the chapter 3. Chapter 3 is trying to record adjusting entry for the period, right? So in other words, that in chapter 2, you deal with external parties, right? Means that you have some sort of the documents and proofs or cash or check or contract that you can use to record a journal entry. But in this chapter, we are trying to do adjusting entry. Majority of the time is internal entries, right? Internal entries means that no one gonna come here to tell you that, hey, you need to book this journal entry. That means that as an accountant, you need to understand the economic essence of the transaction, right? So for example, if this period passing by, you're gonna adjusting the entry. So here has several points that is important that I wanted to tell you about. First is to do adjusting entry to record the revenue that earned during the period that has been paid in advance. In other words, that say you are soccer training academy, right? And you receive, say, $1,000 cash in advance for 2 training session, right? On November 1st. So therefore, on December 1st. So when you have this transaction, last class, you know that you have to debit cash and credit deferred revenue, right? And then for $1,000. And then what if during the December you actually provide a training session already? So no one gonna come to tell you that you need to recognize the revenue. However, you will remember to adjusting this entry for recorded revenue earned. So you will credit the revenue and then reduce deferred revenue for $500, right? Because you only provided one training session, and then therefore you still have $500 training needed to provide, but half of them already done, right? So you would debit deferred revenue to reduce the liability and credit revenue. And in terms of prepaid expenses, remember we said debit supplies and crediting cash last chapter. And then so now you are using the supplies right now. Hence that when you use the supply, you will debit the supplies expenses and crediting supplies, right? Okay. And demonstrating adjusting entry for accrued expenses. So what is accrued expenses? Accrued expenses means that expenses actually really incurred, right? And then you just need to remember to record it. So for example, you have a whole week: Monday, Tuesday, Wednesday, Thursday, and Friday, right? And then people work for you, you pay $100 a day, right? At the year end is actually end on Wednesday, December 31st, year one. So you have to record the 3 days salary expenses for year one. So but the money every time people pay by Fridays, right? So the cash is not hit until Friday. Hence that by the end of year one, you will debit salary expenses and you accrue salaries payable, because this is what we call accrued accounting. We are counting the liability, right, as our duty going, right? Even though it didn't involve cash transaction. And also demonstrate the adjustment to ensure that assets are reported at the amount that representing the economic benefit that remains at the end of the period. This is simply talk about the journal entry debits depreciation expenses and crediting accumulated depreciation, right? And then determine the prepaid expenses and the related expenses. So basically, for example, we talk about the insurance prepaid expenses, right? And then explain that adjustment for accrued expenses such as the salary payable and recognizing accumulated depreciation as a control asset account, and for a long-lived assets such as equipment, differentiation between supplies remaining and supplies used. And all these things, if you understand, then you will perform very well in the exam. So I guess all these are very abstract. So let's look at questions. Okay. Let's look at the questions. So this is a chapter 3 question, accounting cycle exercise. So, okay, while examining the financial statements of Delta Corporation for the year end December 31st, you come across several items needing further considerations. Before any further adjustment are made, net income is $120,000. So they recorded $120,000 of net income. Okay, but they somehow the accountant failed to consider all this impact on the income statement. The first thing they said is an insurance policy covering 12 months was purchased on the October 1st, and for $24,000, and the entire month was debited to the prepaid insurance, and no adjusting entry was made for the item in the current year. So in other words, November 1st to December 31st, how many months there is? October to November, November to December, so 3 months, right? So that means that since the time passing by for 3 months, your prepaid insurance for $24,000 should transfer some to the insurance expenses, right? And then reduce the prepaid insurance, because prepaid is happened on October 1st. After time goes by, it's not prepaid anymore. So it's not prepaid. So right now you are at the year December 31st, year one. So that means 3 months has passing by. So you were converting 3 months prepaid expenses to expenses, right? So $24,000 dividing 12 multiple 3 is $6,000 of prepaid expenses. So since the question saying that no adjusting, this is our adjusting entry. So no adjusting entry was made for this item in current year. So that means that no one made this adjustment entry. So they are under they are missing the $6,000 expenses in the net income. So the net income should decrease in $6,000, right? Because they forget to recognize the expenses for $6,000, so they should decrease the net income for $6,000. Okay. B. During the year, the company received 5,000 cash advances from customer for services to be performed next year, and 5,000 was incorrectly accrued credited to the service revenue. So in other words, when they receive cash in advance without perform until the next year, they incorrectly debit cash and crediting revenue. Why is it incorrectly do that? Because this revenue hasn't been performed yet. Hence, they should be credited into deferred revenue for $5,000. So therefore, this net income is overstated for $5,000. In correcting, we have to reduce $5,000 here. Okay, C. There were no supplies listed in the balance sheet under the asset. However, you discovered that supplies costing $1,800 were on hand on December 31st. So in other words, you thought you used all the supplies, right? So that means you minus a big supply expenses, big one. However, you find that you didn't use all of them. There's 1,800 left still. So that means you overstated that. This means that you overstated supply expenses for 1,800. So in other words, you should increasing your net income for 1,800, right? Okay, so D. Delta borrowed $90,000 from local bank on September 1st. Principal and interest at 12% will be paid on August 31st in the following year. No accrual was made for the interest in the current year. In other words, you borrowed money that we should pay by next year, August 31st. You borrowed on September 1st, and right now is December 31st, year 1. So therefore, you will have 4 months interest passing by, right? October, November, December 1st, so 4 months passing by. So in terms of that, you will have to record interest expenses journal entry and crediting interest payable, because you still haven't paid the interest yet, but the interest expense has already occurred. So how much was that? You will use $90,000 multiple 12% and dividing 12 because it's 12 months and multiple 4, right? Dividing 12 because you want to find out each month how much interest payment it is. Multiple 4 means that how much 4 months cost interest. So that's gonna be 3,600 and 3,600, right? So in other words, this company forget to record this journal entry, hence that their income is inflated for 13,600. So we will reduce the income. The correct is reduce income for 3,600. And then, so the add up all the things together, you will minus $6,000 minus from $120,000. You have adjusting down $6,000, $5,000, adjusting up 1,800, adjusting down 3,600. So it equals 107,200. Okay, so now let's look at this example. Okay, so let's look at this question. Quantum Inc. prepares monthly financial statement for its bank. Oh, sorry. And November 30, the adjusted trial balance includes the following accounts. So this is the November 30th balance of supplies, prepaid insurance, salary payable, and deferred revenue. So they have a different balance on debit side and credit side, right? And then the following information is known for months of December. So this is a transaction went through December. So in other words, we needed to read these sentences and figure out what is the economic essence of each transaction, and then we record adjusting entry accordingly, right? So first, purchase supplies during December of totaled $5,000. Supply on hand at the end of December equals $4,500. And second, no insurance payments are made in December. Insurance cost is $2,500 a month. 3. $13,000 is paid to employee during December for November sales, and additional salaries for December owed at the end of the year are $17,000. And number 4, on November 1st, a tenant pays a quantum $4,500 in advance for rent from period November through January, and deferred revenue was credited to the entire amount. So what we require to do is to show the adjusting entry that were made for supply, prepaid insurance, salary payable, and deferred revenue on December 31st, right? Okay, so I give you guys 3 minutes to look at each one and then give you a guess how to record adjusting entry. Oh, so first of all, why we are recording adjusting entry and how we're gonna record it. Anyway, so since this is recording, I will not interacting with you guys, and so therefore, if you need time, you can pause the video. Instead, I waiting in the recording. Okay, so for solving number 1, so therefore, for example, you have a supplies at the beginning. It's like a cookie jar, right? You had a cookie of $3,000 worth of cookie in the beginning. Right, and then during December you purchased additional supplies for 5,000, so therefore you increased $5,000 worth of cookie in there, so from outside replenished, right? And then so in the end you said, okay, let me see how much cookie have I already eaten. So you find that the supply in the end of the period is 4,500. Hence the leftover like cookie after whole month is only 4,500. So the question from me is how much is you eaten the cookies, right? How much has been eaten or used? So what we will do is use $3,000 for the beginning plus the additional 5,000 for the month and minus the ending balance. And you will find out the usage of supply is 3,500, right? So the 3,500 means the supplies have been used for $3,500. So we're debiting supply expenses and crediting out the supplies for 3,500, right? Okay, very good. Second, no insurance payment are made in December. Insurance cost was $2,500 per month. At the beginning, you know that you have 500 prepaid insurance, right, on November 30th. So this insurance $5,000 prepaid is covering December and January's rent. Since December has been expired, so at the end of December 31st, year 2, year 1, you wanted to record a journal entry here, debit insurance expenses and credit prepaid insurance, right? So for 2,500, okay? Okay, so 13,000 is paid to employee during December for November salaries. Additional salaries of December owed at the end of the year of 17,000. In other words, that you have a salary payable of $13,000 at the beginning of December 1st, and during December you paid off this $13,000 of salary payable, right? So therefore, you will debit in salary payable for $13,000 and crediting cash for $13,000 for the what you owed, right? At the same time, you see additional salary for December owed at the end of the year are 17,000. That means that during December, you're also generating extra $17,000 for salary expenses that you haven't paid. So in other words, there's two events here. The first event is a pay for November debt or owed amount. The second event is to record newly generated salary expenses, right? Hence that you debit salary expenses and crediting salary payable for $17,000 right? Okay, very good. Number 4, on November 1st, a tenant pays a quantum $4,500 in advance rent for a period November through January. A deferred revenue was credited the entire month. So on November 1st, the rent is paying for December and January 1st and January 31st. So on this day, you receive 4,500 cash. This cash is covering 3 months rent, right? So how much for each month? 1,500 for each month, right? Okay, so very good. So therefore, at the end of November 30th, you see, instead of 4,500 right now, it becomes 3,000 deferred revenue. And then when the another month passing by, it should be only $15,000 deferred revenue, because when during December the rent has been earned, right? So in other words, December earned revenue is $1,500. So therefore, we will debit deferred revenue and credit revenue for $1,500. Okay? Okay. So that's how we're taking care of adjusting journal entries. Okay? Okay. Exercise 3. So consider the following transactions for Samara Insurance Company. The first is the equipment costing $60,000 is purchased at the beginning of the year for cash, and the depreciation on the equipment is $10,000 per year, right? Number 2, June 30th, the company lends its chief financial advisor $80,000. Principal and interest are at 5% are due in year 1 year from now. Number 3, October 1st, the company received $24,000 from customer for a 1-year property insurance policy. Deferred revenue is credited. So for each item, record the necessary adjusting entry for the Samara Insurance at its year end of December 31st. No adjusting entry was made during the year. So in other words, first one, you have not only, you needed to consider the adjusting entry on the year end, the ones that usually it's already recorded the external transactions. Now all you need to record is adjusting transactions, right? Okay. So the equipment was costing $60,000 purchased at the beginning of the year for cash. So, but at the year end, we will record depreciation expenses, right? So we were debiting depreciation expense. We're crediting accumulated depreciation. And this is, we call it the control asset account. Means it's reduced assets. Okay, so therefore we are crediting it. When you dealer, D-E-A-L-O-R, so DA is assets. When you reduce asset, you're crediting it, right? So there we go. So we debit $10,000 of depreciation expenses, credit accumulated for depreciation for $10,000. This is the adjusting entry for assets, long-term assets. Okay, number 2, on June 30th, the company lends its CFO. So you are the company, okay, and you lend to the CFO for $80,000. So therefore, and you're charging him 5% a year of interest. So on June 30th to December 31st, how many months there is? 6 months, right? So 6 months, then you should charge CFO 6 months interest receivable, interest revenue, right? So how much interest CFO should pay you if the interest is due on December 31st? You should equals $80,000 multiple 5% multiple 6/12, right? 6/12 because it's a half year, right? So that will be $2,000, right? So actually for $4,000, $400, right? So therefore, in order to record this interest receivable, 40,000 multiple 5% is so sorry, it's gonna be $200, right? So you are debiting interest receivable for $200 and crediting interest revenue for $200 because you are waiting for him to pay you $200 interest for the 6 months period, right? Okay, so number 3, from November 1st, the company received $24,000 from the customer for 1 year property insurance, right? So this means September 30th, year 2. the insurance policy is expired, right? So therefore, every month passing by, you as an insurance company, you should be able to make money, right? So November 1st, December 1st, and December 31st. So if we're standing here, this must be 3 months passing by. Each month passed by as an insurance agent, you will generate revenue, right? When people prepaid you cash for $24,000, this you were debiting cash and crediting deferred revenue for $24,000, right? For the whole year. But every month passing by, that means you make $2,000 a month. You recognize $2,000 revenue each month. So by the year end, you should recognize totally $6,000 of revenue. So you were crediting revenue for $6,000 and debiting deferred revenue for $6,000, because the insurance become your revenue as long as the time goes by, right? Okay. Yeah, 2,000. I'm sorry, 2,000 instead of 200. Okay. Okay. So number 4, consider the following transaction as a Samara insurance company. A, equipment costing $6,000 is purchased at the beginning of the year for cash. The depreciation of equipment is $10,000 per year. B, on June 30th, the company lends to the chief financial officer for $80,000. Principal and interest is 5% are due in 1 year. So therefore, in December 31st, year 1, nothing is due. Nothing is due, right? In terms of you don't need to pay cash yet. October 1st, the company received $24,000 from customer for the whole year property insurance deferred revenues accrued. This is exactly the same as question 3, but what's different is the requirement. What the requires is that for each adjustment indicating how the net income in the income statement is higher or lower. In other words, by recognizing depreciation expenses on the debit side, and crediting accumulated depreciation. Is this increasing or decreasing the revenue? Since you are recognizing new expense account, it should decreasing net income, right? Okay. Oh, but if the adjustment is not recorded, so that's why I highlighted in yellow. So for example, I take it back. If you didn't recognize this journal entry, that means that you are if you forget to debiting depreciation expenses and credit accumulated depreciation, that means your net income will not get hit by this depreciation expense, will not be reduced by this expenses. So the net income is overstated by $10,000 if you do not record this journal entry, right? B. So on June 30th, the company lends a CFO $80,000 and charging interest for 5%, and then due in that's all gonna due in year 1. So therefore, remember we will recognize half year interest revenue. So in other words, we should debit interest receivable and crediting interest revenue for $2,000. But if you didn't do this one, that means that your net income is going to be reduced by $2,000 because you have an interest revenue should be recognized, but you forget, right? Okay, number C. October 1st, the company received $24,000 prepaid insurance for the whole year. Deferred revenue is credit. So therefore, there's a 3 months passing by. You should recognize 3 months insurance revenue already by seeing the debit deferred revenue, credit revenue being recognized revenue for $6,000. If you forget about the record, if you didn't do this journal entry, that means that you understated your revenue for $6,000, right? So okay, let's see. So if you forget to record this expenses, your income is inflated for 10,000, right? Your income. And then if you forget to recognize the interest revenue, then that means your net income gonna be deflated for $2,000. If you forget to recognize the deferred revenue to revenue, right? That means your revenue is gonna be decreased for $6,000. So in total, if you forget about doing 3 transactions, your income is inflated by $2,000. If you forget A, B, C altogether. Okay, so I actually only covered to this question for the last class. So I think if you have a problem so far then this will be also challenging as well. So why don't I stop here, and then you can take tomorrow and tonight to look at these questions. If you have a question, please stop by at my office, or come early on Wednesday, then we can talk about it. And then there's gonna be a lot of year-end adjusting entry exercise we're gonna do. Okay, I see you guys later. Thank you.